In this video, we're going to show you how to use Stockopedia's tools to identify quality companies, using US tech giant Adobe, a truly quality company, as an example. First, a bit of history. Founded in 1982, Adobe was a classic Silicon Valley story, founded out of the garage of a super intelligent tech wizard. Within a year, Steve Jobs had attempted to buy the company, but the founders refused, and instead set up a deal with Apple, licensing the PostScript product. The license gave Adobe a very different start to many Silicon Valley startups, and within its first year was making profits, which were reinvested into new ventures, and by 1985 the company had also launched Illustrator and Photoshop. Revenues came in very quickly. You can see from this chart the way Adobe's licenses made high profits, which the company then reinvested into new ventures. In 1995, Adobe launched the portable document format, PDF, and continued to innovate with new features for the Photoshop product. Fast forward a few years and the way people use computers has changed. By 2012, with the proliferation of the internet and the advent of the cloud, people don't have to buy long-term licenses to have access to software. They can sign up for subscriptions. And so, Adobe has changed its business model. You can see in the results from 2011 to 2015, when the company made the transition from a licensing business to a subscription business, that revenue and profits were impacted. But in the long run, that decision was very sensible, as we can see as we dig into Adobe's stock report. Let's take a look at the numbers in the stock report now. First, there's the revenue, which has risen from $7.3 billion to $17.6 billion in the last 5 years. That's a compound annual growth rate of 19%. The next line down, we can see operating profits have risen even faster in that time. And scrolling down to here, we can see that it's thanks to a widening operating margin, which have averaged 32.5% over the last 5 years. In this cash flow section, we can also see that Adobe's operating and free cash flow generation has been incredibly impressive. The company actually converts well over 120% of its operating profits into cash every year. And crucially, as cash inflows have risen, so has capital expenditure, showing that the company has a good attitude to reinvesting its cash profits. An important metric for assessing quality is return on capital employed, or ROCE. ROCE at Adobe has risen from 19.8% in 2017 to 32% in the last set of results. If we click on the ROCE metric here, we can see what that means and how we have calculated it. And right down here, we can capture a snapshot of the balance sheet health. It shows a net debt figure which is negative, which means Adobe is in a net cash position, and has been for every one of the last 5 years. Returning to our overall picture of Adobe, there are many hallmarks which we're looking for in a quality company. A unique product or service which is almost impossible to replicate and is relied upon by dedicated customers. A highly profitable business model which churns off high margins and plenty of cash. A positive attitude to reinvesting the cash into the business, and reinvestment plans which don't rely on excessive borrowing, which can become expensive. And high returns from that investment, shown by a strong return on capital employed.